such a jump off the page as such a good deal. And then the third piece, and where we'll start, is the team. And so I want to make sure that everybody kind of understands, and if I don't know, who you guys are, that we get a chance to introduce ourselves and our team. So as I mentioned, my name is Andrew Campbell. I'm the founder of Wildhorn Capital. We are an apartment operator, and we are located in Austin, Texas. I was born and raised in Austin, which is about an hour from where the Gables is located. My background, I spent about 15 years in branding and advertising, and about 5 or 6 years ago, started buying rental properties in Austin and San Antonio with my brother. Kind of fell in love with the business, and now this is what I do full time. I have, with my brother, we have about 38 units in San Antonio itself. So very familiar with the market. Have placed a lot of our personal capital there, and plan to hold that for a long time. Believe in the fundamentals of the market. I'll let Reed kind of introduce himself in a bit when he starts talking, but I'll tell you a little bit about our partnership and kind of how we came to partner up. I met Reed at a real estate conference about a year ago, and we started chit-chatting, kind of networking around, and we realized that we had a lot in common. That there was a lot that we were sort of looking for the same types of deals. We were both value-add operators. We had very similar mindset on a lot of things, both kind of in our mid-30s, looking to build long-term businesses and long-term relationships in the business and with investors. And the more we kind of talked, Reed's got a podcast, which he can talk a little bit more about, but I went on his podcast and just had the chance to talk to him a little bit more. We realized we were looking at a lot of the same deals in the same cities, and that we also had very complementary skill sets. My marketing and advertising background, I'm always looking for what's the story here, how are we going to pitch this to tenants, and how are we going to rebrand this asset. Reed's got a structural engineering background and construction management, so he's looking at how is this constructed, and those were very complementary. Location-wise, it was advantageous. I'm in Austin, like I said. We're looking at deals in Texas, so I'm boots on the ground, building relationships, touring assets. Reed's in LA; it's a little bit harder for him to do that. But what Reed had was 2 analysts, and they were able to underwrite 3 to 4 times the amount of deals that I could look at by myself. So as we kept sort of going down the list, there's a lot of things where we just overlapped and decided, let's not go compete on these things. Let's go be partners. And so that's what we've done, and that's what we're proud to do here with the Gables. The third piece of our team I want to talk about, which is obviously important, is our property management company for this asset and all of our San Antonio assets. We're partnered with Clear Property Management. They are based in Austin, Texas, and they exclusively operate in Texas. We like them for a lot of reasons, but a couple of them I'll walk through. Number one, they're local, so we can get access to them. They have sufficient scale and size. They manage a $500 million portfolio, which is about 3,800 doors. And they have 8 or 9 assets in San Antonio itself. So they're very, very familiar with the state and with the market that we're in. They actually have a couple of assets, in the same sub-market here, so they can tell us, where we're going to be operating the property. I think our favorite thing about Clear, though, is the access we have to the high levels, because it's not, a gigantic company where we're just a sort of another client. And our favorite thing about them is that they only do value-add repositioning. So this is their bread and butter. It's a very different thing to operate a sort of stable Class A apartment. These guys are used to the construction management piece. They have in-house construction management. They're used to having a lot of crews walking around and turnover and work being done on the property. That's what they do all day, every day. So Clear is our property manager and kind of rounds out, the 3 legs of our stool between myself, Reed, and Clear Property Management. The other thing that as we kind of move on, and talk about outside of our team is what do we like about the deal and the market. And specifically, I want to talk about San Antonio, which is really where Reed and my partnership sort of started. We were comparing notes. San Antonio kept coming up. We were naming the same assets that we had been looking at, that I had been touring, driving down, every week to look at these different things. And about 6 months ago, we really circled San Antonio as a place that, okay, let's consolidate our efforts there, and let's see what we can turn up. And specifically in San Antonio, we were looking for on the north side. We wanted to find deals on the north and northwest side where all of the growth was happening. San Antonio itself, why do we like it? You know, it's a large city in Texas. You know, Texas by itself is growing. San Antonio is growing at a 7% clip. It's got 2 million people. The area that we're buying in the northwest side is growing at a phenomenal rate. I think since 2000, it's seen over 16% growth, and it's projected to see 10% growth between now and 2022. It's a very employable city. I think the unemployment rate is currently under 4%. They're expected to add 30,000 jobs to San Antonio this year. So it's a city where the jobs are going, and I think a good example of that is Hulu. Hulu just announced, the online streaming service just announced they're going to move their U.S. operations, or they call it their viewing experience operations headquarters, to San Antonio. It's actually going to be located 3 miles from the Gables property site. So a lot of good things happening in the city and really within this specific submarket. I think, you know, if you're familiar with San Antonio, this property is located basically at the intersection of I-10 and Huebner Rd. It's adjacent to the USAA corporate campus, where there's 16,000 jobs. And right next door to that is the South Texas Medical Center. The medical center is, you know, very well known, sort of an anchor of employment and activity in San Antonio and for the whole region. It's like a 900-acre complex of hospitals that's seeing $1 billion poured into it right now in additions, and in the addition of a children's hospital. There's 50,000 jobs just in the medical center. So we're located in an extremely desirable location within San Antonio. In the 5-mile radius around the Gables property, the average income is $75,000, and there are 150,000 jobs. Also within that submarket, the CoStar, one of the third-party tracking companies, has tracked effective rent growth in the last 12 months of 4.3%. In our underwriting, we are operating to expecting 2.5% rent growth. So we're being very conservative in our rent growth, but we're in an area where they're seeing consistent and steady rent growth. So that's the market, and that's why we like San Antonio at large, and we just really love this northwest corridor where the Gables is. The other two things I want to briefly kind of touch on and highlight. Number one is, excuse me. Number one is this story and kind of with the current ownership. This property was purchased in 2007 by a REIT, and their business plan has been, and they've successfully executed it, to hold it for 10 years and to manage it to occupancy and to sell it. They've had it for 9.5 years, and we'll be buying it at the end of that 10 years period for them. Kind of as a standard, you know, REITs typically buy a property, buy an asset like this, and they want to maintain it, which they've done a really nice job of. They replaced the roofs 2 years ago. It's a very clean asset. It's got there's not a lot of deferred maintenance on it, but they haven't upgraded it at all. They haven't put any systemic upgrade packages together. Overall, it feels just a little bit tired and a little bit dated. Meanwhile, the area around it has exploded with Class A retail next door to us. There's Class A apartment buildings across the street. It's a really good opportunity for us to come in and systematically upgrade it in a really desirable location where there's a lot of meat on the bone to increase rents and come up to what the market is demanding in this sort of more affluent area. So we're really, really excited about the story there and the fact that it's been just sort of very well maintained but not upgraded. And the last thing I want to talk very briefly about, and Reed will get into more detail, is the debt that we're able to place on this asset. We'll be getting government-backed Freddie Mac loan on this with a 30-year amortization schedule and a 7-year fixed rate. Our business plan is to hold this for 5 years, but we're going to have multiple years of interest only, and we're talking about a 4.1 or 4.2% interest rate. And this truly is sort of the gold standard for multifamily investing, getting debt backed by the agencies. And it really reduces the overall risk profile of the investment, and it gives us a lot of confidence in knowing that for the life that we plan to hold this asset, we've got very stable, solid debt in place. So those are the three reasons that I really like the asset: the location, the story with the current ownership, and the debt that we're going to be able to get on it. And I'm going to turn it over to Reed, who can walk us through some of the financial details in our business plan.
Thanks a lot, Andrew. for those of you, if you do have any questions, as I said, Andrew, do you want to repeat your email again for the people listening?
Yeah.
They want to shoot through any questions in the next 10, 15 minutes as I speak about the underwriting.
Absolutely, yeah. Email andrew@wildhorncap.com.
Perfect. Yeah, thanks, Andrew. Great introduction. For those of you who don't know who I am, my name is Reed Goosens. I am the founder of RSM Property Group. I'm also the host of the #1 show podcast geared towards helping international investors break into the US market, which is called Investing in the US. My background is in structural engineering and construction management. I've spent the better part of my career since 2006 in working in the engineering, construction, and real estate development on multifamily, retail, and infrastructure across the world, both in Australia, Europe, England, Fiji, Thailand, and here in the United States, both in LA and in New York. Over my career, I've been involved in excess of project worth of $500 million, both in project management role, also stakeholder ownership representative role, and also as a construction CM in my early days coming out of university. Most notably, I'm pretty proud of being able. I did work on 2012 development for the Olympic Games in London back in 2008. So very proud to have that on my resume. And if any of you do know, the Paddington Station in London is one of the major iconic symbols of the Olympics, and that was where I worked. I moved to the United States about 5.5 years ago, to pursue not only my interest in real estate and investing here, but to pursue my fiance, who's now my wife. She is American, so the reason I moved to the United States was twofold. Since then, the intent was always to buy and start my own real estate investing firm, and the United States did offer a fantastic place to get things done. As I mentioned, I want to touch on a few things tonight. I want to also touch on one thing that Andrew mentioned. We have come together to form a partnership. We've been involved as co-GPs in over 1,100 units in the Texas market. So both Andrew and I are very, very well versed with this Texas market and Texas portfolio. The reason why we are so interested in Texas and why we like Texas is due to a number of things, and those number of things are strong, diverse economies of MSAs such as Dallas-Fort Worth, which we have with co-GPs on a number of units. Austin, another great, fantastic MSA, but also San Antonio as sort of the forgotten cousin. I've toured San Antonio a numerous amount of times over the years. I can definitely see the corridor between Austin and San Antonio, just from an infrastructure point of view, being an engineer. You can just see that blowing up in the next 10 years. I really think there's some huge growth there. I remember the other day when we were driving home back from San Antonio with Andrew to Austin. I think it takes about an hour. It took us 2.5 hours due to traffic. So good indications that there's definitely a lot of growth happening along that corridor. And this particular deal, the Gables, is definitely situated in a fantastic growth area. Again, from a macro point of view of why we like these secondary markets compared to, say, the coastal markets, is the cash flow per pound compared to those coastal cities like Los Angeles, New York, San Francisco, and Boston, just to name a few. Texas has been with the strong, stable economies, great job diversification, but also has the ability to have some moderate cap rates, which will then produce fantastic cash flow on the assets in which we buy them. So from a sort of 30,000 foot level, the reason we are investing in and around Texas is because of those three major items, as I said before. Fantastic growth in the market not only from a population point of view, but from a jobs growth point of view. Fantastic moderate cap rates. in and around major MSAs like San Antonio, and as Andrew stated before, some fantastic growth that is happening in and around the next 10 years with some major companies like Hulu, and obviously I'll dive into the sub-market of why the sub-market makes sense, but from a macro point of view, very strong 2 million population and continuing to grow over the next 10 years. So I want to dive a little bit deeper, and what I'm going to cover is get a bit more into the nuts and bolts. Being an engineer, I am very much in the nuts and bolts and the numbers guy, and I want to talk about how we came about to find the Gables. So currently, the portfolio that we're involved in is very much based on the 1980s solid Class B value add assets in and around the Texas markets. So we're very familiar with this type of asset that we're buying. We've been continually underwriting deals over the last 6 to 12 months. It has been very difficult to get a deal to pencil with being so competitive in that sort of Class C 1980s solid value add. So when we're looking to, as cap rates are compressing and the market is getting more and more competitive, we definitely had at the beginning of the year when Andrew and I were sort of looking at our investment strategy for 2017, and with my analysts and what we were chasing, we really had to get clear on how we'll still be competitive with our offers, still remain conservative with our underwriting, but also to get deals won, and over the line. Just to give you a bit of background, I think we've underwritten nearly close to 85 properties just in the last 6 months in San Antonio area. And this is the first property. We've obviously bid on a number of properties and we're not able to win them. But Gables, when we went and toured it a couple of months ago, was the standout asset, and we definitely earmarked this as an asset that we wanted to take down and take down seriously. So we spent a lot of time with the brokers looking for this asset. But back to sort of the high level point of view is, at the beginning of the year, we sort of said to ourselves, why not look for a better quality asset with the same sort of purchase cap rates as those competitive Class C space, but still have a lot of meat left on the bone. And in essence, what we were describing back in early 2017, we wanted a better quality asset in better locations, but we were essentially describing the Gables. And what that meant was that we had to go out there and obviously hit the pavement and try and find those types of assets, come out of that sort of Class C space and into the more of the Class B, because the reason behind that is that you can, as I said, you can buy an asset, a better quality asset, do less of the legwork because the cap rates are the same, but get still very solid cash on cash returns. And from a risk point of view, and a capital preservation point of view, which is definitely the number one goal of what we are trying to achieve with any of the investments we buy, is capital preservation. But you get to have, it's a less risky deal because it is a nicer type of asset. Now, as Andrew mentioned, the asset is in a great affluent submarket of North San Antonio, surrounded by some fantastic Class A retail, very strong employment base, as Andrew has mentioned, 50,000 jobs in the South Texas Medical Center, which is fantastic. Also with the USAA having over 16,000 jobs. So very strong jobs market within a stone's throw of the property. So that first and foremost ticked the box in terms of what our MO was for the beginning of the year. We needed to find a fantastic submarket. Yes, ticked, found it in a very strong growing market. Tick, that was that. And then we, coming across, looking at all the Class B that was coming on the market. This particular deal piqued our interest due to, again, the close proximity to other Class A retail. Literally across the street, there's Class A retail along Huebner Rd. There is some Class A construction going on right now. But the major thing was we're not trying to compete with Class A. We're trying to look for that value add component. So there's a lot of meat left on the bone, well-maintained asset that we can go in and produce fantastic cash flow for our investors. So in essence, this is exactly what we were trying to look for, and it ticked all the boxes, and we were very ecstatic when we heard that we had won the deal. Again, I've driven the area some many times. It's a very, very lovely area. You can see why the people are living there, wanting to be close to work. and the area, is continuing to grow. It has a vibe about it. Starbucks is just down the road. You've got, Victoria's Secrets in the Class A retail. You've got some big chains that are literally not even a quarter of a mile or less than a quarter of a mile down the road. In terms of the business plan and why I also like this deal, if we talk about, so we've gone from the macro 30,000 foot, we've gone into the sub-market, going to go into the business plan of financial underwriting. As Andrew mentioned, it's owned by a REIT. Currently, the REIT is based out of Utah. They've owned it for 9 years. They do in-house, they self-manage the property. They currently only have 3 employees on the property right now. So there was definitely some efficiencies I saw when we first rocked up to the apartment. They've only completed 8% of the silver upgrades. Now you're going to hear me talk about silver, bronze, and gold. Silver being a standard of upgrade that we typically do in class in your multifamily repositions. They've also completed 70 of the units with the bronze package. Now it's a very basic package, just repainting cabinets, putting in very basic flooring, but still with the white appliances. Nothing over the ordinary. So the reason why I like this is because it still has a fantastic bones to the deal. And when you walk the property, you definitely get that feeling with all the fantastic amenities. The pool is very nice. They've got a really nice gym. They've got a spa as well. I've also noticed some of, there's a couple of new Priuses in the car parks. There's a couple of few Beamers. So in terms of the demographic, you can definitely see when you're walking the property, the demographic that is living there is more of a white collar demographic, which is fantastic. But then when you walk inside some of the unrenovated units, it just doesn't jive with what's happening around the market. So again, the bones and the fundamentals of this property, fantastic location, but definitely needs a bit of work from a cosmetic point of view. The renovations that they have done on the silver package, they've been very, very well received, and I am, and done a very, very good job based on our, analysis of the market and my analysts who cold call all the properties in and around the comps, and we also got it vetted by our third-party property management, Clear. The stuff that is coming online, other Class B assets are doing, more of a gold package with their upgrades, to try and be that more of affordable asset for, when some Class A comes online, particularly the one across the street. So the major thing that I noticed in our survey was that for renovated product, and if everyone's reviewed the IM, the investment memorandum, you can see that for renovated product in literally the immediate vicinity is over $1.20 for Class B, the same Class B vintage. I would argue that we have the opportunity to really push this to a Class B plus, given the location of the asset, the visual, where it's located on Huebner Rd, the amount of traffic that it gets past. It's right on Huebner Rd, so we have fantastic advertising opportunities. But for the same sort of for renovated Class B vintage, they're getting $1.20, over $1.20 a square foot. In terms of what I like about this property is that it still pencils with very, very conservative underwriting. I have underwritten the property to $1.14 a square foot across the board, and that is again very, very well under Class B vintage for comps in the area. Class A is trading around about $1.40, and the Class A directly across the street is at $1.40. I am, again, the business plan isn't to compete with Class A. It is to be the affordable alternative, however, with the same type of amenities, and I'll get into some of the amenities that we'll be adding in a little bit. So again, back to having those same type of amenities, but not having the price tag involved, and still being very, very close to all the employment opportunities, which is what the younger generation want. In terms of the demographic we're going after, and it is the white collar, late 20s to early 40s young professional. As I said, we're looking for household incomes plus $50,000 a year, and with all the local USAA employment opportunities and the medical center, we're easily seeing that in types of the demographic that are looking to rent. to be within a stone's throw of those types of major employers. So again, going back to the fundamentals, remaining conservative with the rental premiums to also reduces risk to the deal. And it further also maintains the in-place occupancy at a healthy rate. Currently, right now, I just checked the occupancy of the property. It's gone up a little bit to 97% occupancy. The market occupancy is right around 95, and historically it's been right around that number. So, which indicates to me that yes, the current owners aren't really pushing the rents, but they also haven't, justified to turn that. They haven't turned the units, so they can't really do it. So my motto is always to remain, very conservative within my parameters, and still, because it still pencils at that conservative underwriting. That's why I really, really like this deal. One other item that I think Andrew mentioned before that we have remained conservative on is the rental growth year on year. As Andrew stated, the CoStar data is also backed up by Reese, another agency that does a lot of market research. Is projecting 4% in the last 12 months. Sorry, it was 4% in the last 12 months. And it's projecting to continue that in 2017 and beyond. I've only underwritten to a 2.5%. So again, remaining very, very conservative within our underwriting. Another thing about this property is that the expenses are a little bit bloated, and we've underwritten based on actuals, but we've also underwritten based on what third-party property management clear. They've reviewed the operating expenses, as have I, in the P&L. And you can see why some of the items like maintenance is a little bit bloated. It's just indicating some few things that we need to address in terms of the CapEx. And we've covered that in the CapEx budget. Again, as Andrew mentioned, Clear owns it doesn't own, but operates over 4,000 units in the San Antonio market, and we're very, very confident on the intel that they're providing us on the operating numbers, and that they will hit those operating numbers moving forward. So combining all those things with the conservative underwriting, just to summarize, low projected rental premiums, and low projected rental premiums. Also talking about low rental growth. The low rental growth that are year on year with 3.5%, and bloated expenses. And that's why I really, really like this deal, and it still pencils out to hit our investors' preferred return, which is fantastic. The final thing that I'm going to touch on and go a little bit more dive deeper into is obviously the debt financing. Other deals, we are not pursuing high-levered bridge financing that you see sometimes in the market. We do not believe in that. High leverage obviously adds a lot of risk to a deal. So we are conservatively, getting the gold standard of debt financing on this property, and that's straight out of the gate, which also is a good indication on the asset itself that Freddie Mac wants to lend on such an asset, and they're quoting us around 75 to 77%. And with a quote of around 4.1 to 4.2. So depending on where treasuries are in about 2 months when we close, we're sitting in very, very good stead about with this debt. We're going to have about 2 or 3 years interest only. The other thing I really like about this loan and the interest rates and the terms we're having on it is that, when we go to transition out of the asset, which may be as early as year 3, depending if we hit the pro formas, but more likely is going to be year 5, it'll be very, very attractive interest rates for a buyer to assume. So, if the world changes and interest rates rise over the next 5 years, our interest rates remain the same because it is a fixed rate interest loan. And hopefully this will make the property a lot more attractive to the next buyer when we go to sell. The last point that I want to make on the debt financing is that a lot of our other assets that Andrew and I are involved in, we pursue refinancing. Now, refinancing isn't an option on an agency debt. So you pay back the full amount of the loan and you place a new loan on the property. But we're going to do something very, very similar, which is called placing a supplemental. And Freddie Mac is very flexible with placing supplemental loans on existing loans, but only when the NOI supports it, so the net operating income. Which we are projecting to hit that new NOI within 18 to 24 months. So the plan is, from a business plan, is to go in there, do all the renovations on a natural organic turn, focusing on silver and gold packages for the first 12 months, and then focusing more on those bronze that have already been hit in the later part of that 18 months. And what we'll do, we'll go in once leases expire, we will offer the tenants, if they want to stay, we can upgrade their unit and bring the rent up to $1.14 a square foot, or they will leave and we'll completely renovate the unit and we'll offer it to the market again. But what that means is that once the process is complete, we'll go back to Freddie Mac, and we'll place a supplemental loan, and hopefully that supplemental will be a sizable chunk of equity which will pay back to investors. Now, the reason I'm mentioning all this is definitely that this is part of our business plan. But if you've read through the IM and the business plan itself, it's not something that I'm underwriting to, nor am I counting on that we are going to be exiting. And I haven't projected that in any of the returns in the IM. And again, it goes back to conservative underwriting. This is an ace up the sleeve that we always do as part of our business plans, but we're not projecting that to investors. And nor would we ever want to project that to our investors. So in general, they're the big ticket items about why I love this investment. I love the area from a sub-market point of view. I love the asset itself that has a fantastic amount of meat on the bone. Some really fantastic opportunities to go in there, update the light fixtures, the plumbing fixtures, the sinks, the appliances, very cosmetic stuff, which was really going to get us a bang for our buck. Bringing it up to a very conservative $1.14 a square foot when the market is trading more at $1.20, and then obviously placing that fantastic debt on it, which obviously reduces the overall risk to the property. So all in all, I really love this property and really excited to have it join our portfolio in a couple of months' time. So now I'm going to turn it over to questions. Andrew, do you have any questions right this second?
Yeah, that's perfect, Reed. And I think as the questions keep coming in, remind anybody else that might have joined lately, email me your questions, Andrew@wildhorncap.com.